In today's video, we're going to be taking a look at Owl Rock Capital Corporation, ticker ORCC. This is the first video a part of my portfolio series where I'm doing an analysis of all 31 stocks currently in my own personal portfolio. If you're new to my channel, my primary focus is on income investing and also dividend growth investing with holdings that offer at least 4% yields. And I'll say this in every video in this series, this isn't done in any particular order. So just because this video is first in this series does not mean that this is my favorite stock or my largest holding. Also note that because I own all these stocks, I am biased towards them, so do your own research before making any investment decision for yourself. Also let me know if there's any improvements to this series I can make going forward. Logging into my Vanguard account where I do all my dividend investing, as of the making of this video, I currently own 684.514 shares of ORCC stock. Owl Rock pays a quarterly dividend, with their last being for 33 cents per share, not including the occasional special dividends that this stock pays. With the number of shares I own, I currently receive $225.89 in dividends each quarter, or divided by 3, which is what I like to do, that comes out to roughly $75.29 a month in dividends from Owl Rock. This stock is currently one of my larger holdings both in terms of capital invested and how much I collect in dividends, but there's still a few other holdings I have that are much larger than this. Owl Rock Capital Corporation is a business development company, which is an organization that invests in small and medium-sized businesses as well as distressed businesses in certain situations. They provide financing for U.S. middle-market companies across a range of different sectors. Owl Rock seeks investment opportunities with favorable risk-adjusted returns, including senior secured, subordinated, or mezzanine loans. They aim to provide investors with favorable returns across credit cycles with an emphasis on preserving capital. Owl Rock Capital was founded back in 2015, but they didn't have their IPO until 2019. This company is also owned by Blue Owl Capital, which is a large alternative asset management company. I remember coming across this stock several years ago and really being impressed with it for a few reasons. When it came to BDCs, it's usually better to go with the ones that have longer track records. That's because BDCs mostly invest in smaller, non-public companies. Because these businesses don't publicly release their financials, it can be difficult to see how well a BDC's investments are doing. You can usually see a list of what they invested on their website or going to the SEC's website, but if you try Googling any of these companies' names, you're really not going to get much information on how well they're doing financially. So therefore, this makes it a good idea to prioritize business development companies that have been around for many years. This gives us the opportunity to look at a BDC's past financial performance, their stock's share price performance, and also if they've had any dividend cuts in the past. So with Owl Rock just having their IPO back in 2019, and then we went through the pandemic plunge and then the bear market since last year, this hasn't really given us much time to observe this stock's performance. But like I said, there are a few things that stood out to me about this company despite being very, very young in their industry. First was the fact that despite not having their IPO until 4 years ago, Owl Rock has already become one of the largest BDCs in the industry. According to Sovereign Wealth Fund Institute, this BDC is currently the third largest in their industry with $13.2 billion worth of total assets. Anytime I'm looking at a BDC, I think it's always a good idea to look at their investment portfolio. Although the size of the portfolio doesn't guarantee better performance obviously, what it does usually mean, however, is better diversification of their holdings. Just like us as individual investors, we should seek to well diversify our own holdings inside our own stock portfolios. Ensuring we hold investments across different industries like real estate, energy, utilities, as well as a solid dividend growth ETF in my opinion, will help protect us in case any of our investments fail. If there's a dividend cut in one of our holdings, then we'll still have plenty of other holdings to help ensure that we can either keep reinvesting and growing our portfolios or additional holdings to supply us with money if we're currently living off dividends. If we look at their latest investor presentation, we can see their portfolio highlights. Over on the right, they break down what industries they invest in. Owl Rock's portfolio is pretty well diversified with internet software and services being their largest sector. Then moving down the line, you can see insurance, food and beverage, manufacturing, and so forth. What's good about their sector diversification is that they're not invested in the higher risk kind of companies. It's for this reason that I don't own Trinity Capital, which has become a pretty popular BDC in this sector for the past couple years. Trinity also offers a high dividend yield, and they've been successful at growing their dividends almost every single quarter since their IPO back in 2021. But the issue I've always had with them is that they invest in tech startups and crypto companies, which are much higher risk investments. Owl Rock Capital, like the majority of BDCs out there, avoid these kinds of sectors altogether. Roughly 86% of their investments are in senior secured investments. I've shown this pyramid several times in the past, but you can see the order of priority that senior debt comes into play. If a company Owl Rock invests in goes through some really difficult situations or even bankruptcy, the senior debt holders are going to be the first in line to get their capital back. If the company goes bankrupt and they have to liquefy all of their assets, then you can see that senior debt holders would be first in line to get the proceeds. 86% senior debt is probably about average for a BDC, but I have seen some BDCs with less and some with more. While senior debt does add more safety, unsecured debt and equity investments actually have better opportunity for growth, which is a downside. Although they've only been around since 2019, Owl Rock has never cut their dividend in their history. They've actually increased their dividend for the first time in December, and they've also had a long history of paying special dividends too, which is always nice. This can help be attributed to the fact that 98% of Owl Rock's investments are in floating rate debt. What this means is, as interest rates rise, then the companies that took out debt from Owl Rock Capital will now have to pay much higher interest rates to them. This helps boost income for the company, but at the same time, it also increases default risk if interest rates keep going too high. It's entirely possible that a company borrowing money from Owl Rock Capital could become financially distressed if interest rates keep soaring as high as they have. That's where having a conservative portfolio can be really helpful for a company. Right now, I'm just going to mention some additional odds and ends that I really like about Owl Rock Capital. Currently, only 3 of their loans are on non-accrual status. This means these companies aren't able to make interest payments on their loans, thus Owl Rock isn't earning any income from this debt. But remember, with the company having a portfolio of over $13 billion and they have investments in 184 companies as of last quarter, having just 3 loans on non-accrual status is better than average from what I've seen for a BDC. I also like their insider ownership percentage, which is 1.6% according to FinViz. It's slightly above average from what I've seen, which is a good sign that the board believes in their ability to deliver solid returns to shareholders. Obviously, since you can see inside the company because you work for there, if you have a lot of confidence in your future performance, then it makes sense for the board and the CEO to own lots of shares of their own company. I also really like just how well this company reports their financial results and their metrics. I've seen other BDCs report their results with less organized information, so this does make it easier to interpret Owl Rock's. They also have this portfolio performance report, which shows how well their investments have been doing. You can see as of last quarter, 13% of their investments are doing better than expected, 77% are average, 10% are below average, and then less than 1% are significantly below average or even at default risk. This kind of metric is something that I wish other BDCs reported, but these results in their investor presentation are pretty good. Their stock also has 4 investment grade ratings, which is also good. It's not the most crucial thing, obviously, to point out, but it is good when you have more analysts and institutions covering a stock and giving it a good rating. It can help make the stock more attractive to financial firms who will want to purchase it, thus help boost its performance. With that being said, that's going to wrap up our look at Owl Rock Capital. Over the years, it's become one of my favorite income holdings and probably my second favorite business development company right now. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis I do in this series. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to click that thumbs up button and also click subscribe if you want to see more higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.